Welcome to our second lesson in taxation. The first lesson we took you through the source of taxation in Ghana and the interpretation of the Tax Acts. And we give you a practice question on that, which I expect my students to work on and then submit them for marking and their advice. The second lesson for today, if we are going by the syllabus, strictly speaking, we're supposed to learn certain specialized businesses. And one of them is banking. And we're going to look at, it's a very short exercise that we're going to look at. Taxation of banking business, what the law says about it. So if you look at it, it's enshrined in section 87 to 88 of the Income Tax Act of 2015 at 896. This is where we derive this source from. Okay. So, introduction. For the purpose of the Act, in other words, which Act am I referring to? I'm referring to the Income Tax Act of 2015 at 896, section 87 to 88. Okay. So for the purpose of that act, any other business activity of a person who engages in a banking business is a separate business activity from the banking business engaged in by that person. And the person shall keep the books of account of each business activity separate. So here what they are trying to emphasize in is the concept of separate income based upon the separate business activity being carried out by the bank or the financial institution. This topic also will stand for financial institutions as well. Okay. So the point you are making here is that if there is a bank, the main activity of a bank is to accept deposits and to give out credits. If a bank is seen to be engaging in activities outside, not from this main activity, banking activity, but other activity, a bank is not precluded from engaging in other business activity aside from the banking business. So the law is saying that where a bank engages in separate business activity aside from the banking business, then the law is saying that then there's a need for that person being the bank to keep what? To keep the books of account of each business activity what? Separate. So when you give a particular exercise where a bank, apart from its banking business, is engaged in other business activity, and they give you the revenue and expense items of the banking business and the other business activity, what's important is that you are supposed to arrive at the accessible income and, for that matter, the chargeable income of the banking business, separate from what? Separate from the other business activity. That's the core of this particular aspect of the law. Where the income of a person who engages in both a banking business and another business activity is to be ascertained, the person doing the computation shall compute the income or loss from the banking business for the year of assessment, separate from where? Separate from the income or loss from the other business activity for that year. So it's important that it means that for each of the business activity, you must determine the income or the loss of the banking business separately from the other business activity of the bank or the financial institution. That's by way of introduction. And I would like to buttress this by let's go to the practice note on this. The practice note on the banking business. What I just said. Okay. Application of the law. The provisions of sections 87.1 and 88.4 of the Act requires that a company engaged in a banking business as defined under section 90 of the Banking Act of 2004. The banking business has been defined in the Banking Act of 2004 at 673. Okay, and the first schedule of the non-bank financial institution. I told that this topic is for both bank and non-bank financial institutions. Okay, should keep the banking business separate from where? Separate from the other business activities of the company. So the practice notes, which shows you the Commissioner General's general interpretation of the Act, is trying to explain further what the law says regarding 87 and 88. Okay, separate books of accounts are required to be kept for the banking business and the other business activities of the bank. And for that matter, the chargeable income from the banking business of a person is required to be determined separately from where? From the chargeable income of the other business activity of the person. This is an illustration. A company that engages in a banking business, asset management business, and insurance business is required to keep separate books of accounts for the banking business, the asset management business, and the insurance business. The chargeable income of the company, so we are keeping separate books of accounts, and for that matter, the chargeable income of the company is required to be determined separately from the banking business, the asset management business, and the insurance business. Some banks may be engaged in their banking business. They may be doing some asset management businesses as well. And some banks also carry out insurance business. Sometimes when you go, they ask you what kind of policy do you have, whether you have a child policy for your children and all that. You see, you are a bank, but why are you engaged in insurance business? It is possible. So the law is saying that the aspect of the tax law is saying that section 87 and 88 of the Income Tax Act of 2015 at 896 as amended is saying that when that happens, the company being the bank should keep separate books of account for its banking business, different from what? The other business activity. For example, the asset management business and the insurance business. That's the illustration. This illustration is just to hammer the separate income streams that are not supposed to be kept by the same company being the bank. Illustration 2. Company A is engaged in the business of banking, asset management, and insurance. Information gathered from their records indicates the following performance results for the year. Now, if you look at the information in their records, we have the banking business, the asset management business, and the insurance business. Their gross profit, the expenses, okay, the expenses, as you can see, and then we have the net profit before tax, the net profit before tax. We have the non-allowable expenses. These are expenses. When an expense is said to be a non-allowable expense, means the expense is not so going to be deducted in arriving at the chargeable income from the tax perspective. So if you are given a particular full-blown question, they may not give you the whole figure as it is like this, but they will give you some expenses which are not allowed for tax purposes. And it's one of the things we are going to learn seriously when we are doing the business income. So we have the non-allowable expense for each of the business activities. And then we have the capital allowance, which is an allowable expense for every business that employs depreciable assets in running its business. Now, the requirement is that you have to determine the chargeable income of the business of the company, A, as required under what? The Income Tax Act of 2015 at 896 for the 2016 year of assessment. So this particular illustration is a company A that is engaged in a banking business, but in addition has an asset management business and an insurance business as well. Okay. The question is, though it is the same company, should we determine the profit of all these business activities and put it together as one before we slap the tax on it? The law says no. Any business of a bank that's engaged in other activities other than the banking business should keep separate books of account for each business activity different from that of the banking business. And for that matter, the assessable income and the chargeable income is supposed to be arrived at, or the loss is supposed to be arrived at for each of the business activities. So if you want to look at the solution to these, you will see that the net profit before the tax, as stipulated in the question, you see, when we are doing examination of accounts, we normally start with the net profit before tax. We don't go and start preparing accounts by itself. So normally when you are given a question, you'll be given a profit before tax. And that is the profit that you adjust for tax purposes. Okay, so you start with the net profit before the tax. You see, you start with the net profit before the tax. And before you do that, any adjustment to the profit. So the net profit before the tax, and then we come to what? We come to, they say add back non-allowable expenses. Remember, the gross profit less the expenses gave you the net profit before the tax. And like I'm saying, in taxation, when we are arriving at chargeable income and you have been given the profit before the tax, you don't go back and start calculating the whole accounts again. No, you start with the profit before the tax. And then if there have been some expenses, remember that gross profit expenses. Now the expenses, they are telling you that out of these expenses, 200,000 for the banking business is not supposed to be allowed. 50,000 from the asset management business is not supposed to be allowed. And 50,000 from the insurance business is not supposed to be allowed for tax purposes. Therefore, when you start from the net profit before that, remember these non-allowable expenses are already enshrined in the total expenses of the 800. So because of that, when you take your net profit before the tax, you have to add back all the non-allowable expenses, okay, to arrive at what? The adjusted profit. Okay, so this figure of 600, 150, 600, 150, and then what? 100 are what you call the adjusted profit. You have adjusted the profit for tax purposes. And since capital allowance is supposed to be allowed for every business, in some questions you have to do the calculation to determine the capital allowance yourself. But in some cases, you'll be given the figure as it is in this illustration. So in that case, you subtract the capital allowance from it to arrive at what we call the chargeable income. So what have you done? It means that going back at 2015, at 896 session 87 and 88, you've been able to determine the chargeable income of each business separately. So therefore, the banking business, its chargeable income is 350. The asset management business is 70,000, and the insurance is 25,000. If you are required to compute the tax liability, now because these are companies, you slap 25% on them once they're not listed on the Ghana Stock Exchange. So 25% on 350, 25% of 70,000, and 25% on what? 25,000 to get the tax liability. Now let's assume that this asset management aspect of the business made a loss. Okay. For example, let's say the adjusted profit was 60,000, and when you let the capital allowance of 80,000 from it, the result will be a loss of what? A loss of 20,000. So that when you put it in the bracket, so it means that here you are going to stroke it. You say chargeable income stroke loss, and the loss will represent the one which will be negative. Okay. And the question is, can you charge the loss of one business, for example, the asset management business, against the profit of this one before you tax? No. The law says no. Each business activity is supposed to be done separately. Therefore, you cannot charge a loss of one business against the profit of another, though it is for the same company. So that is that when it comes to the separate business activity of the bank. So let's go back. So I'm taking you back again. These two illustrations was to hammer the issue of separate business activity of a bank. Now the second thing you will be learning under this topic, you have to learn separate business income. That's number one. The second one is when it comes to provision for a debt claim of banks and other non-bank financial institutions. What does the Income Tax Act says? Whether those provisions are they allowable expenses? You know, one of the main challenges of bank is non-performing loans. You are aware. And when it comes to most of these non-bank financial institutions, one of their headache is the non-performing loans, which sometimes turn out to be bad debts. Okay, and because the bank, in order to be prudent, they always want to make provision, okay, for these debt claims. The question is, are these provisions allowed for tax purposes when it comes to banks? And I want you to take it this way. Take note of this as you are even looking at it. As we are projecting this, you can also note this down. Look at, first of all, provision for bad debts in terms of what general provision. Number two, provision for bad debts in terms of specific provision. And then we'll talk about bad debt recovered. Bad debt recovered. Okay? Because you may make provision, but you may recover them. And then also, what if the debt itself goes bad? In other words, not a provision. Okay. So the law says that where a person conducting a banking business makes a specific provision for a debt claim, which the Commissioner General is satisfied. Look at the words which are being chosen carefully. Normally, when you make a specific provision for a bad debt claim, the Commissioner General should be what? Should be satisfied as a bad debt. Then in that case, in the case of a debt claim that has been previously included in calculating the income from the business, the provision is deductible. So the point here they are making is that if you make a specific provision for a debt claim, okay, that provision should relate to what? Should relate to prior years. Prior years, not the year itself under consideration. So for example, assuming you are making a provision, specific provision, please, the word here is what? Specific provision for a debt claim. If that specific provision for a debt claim maybe in 2017, the specific provision for debt claim is, let's say, 1 million. The point they are making is that that specific provision should relate to what? Debt claims of previous years. For example, 2016, 2015. Not debt claims for the year itself under consideration. If it is debt claim for the year itself under consideration, it will not be allowed. So specific provisions for debt claims that relates to what? Previously included in calculating income from what? The provision. Previously included in calculating income from the previously means that the year before the year under consideration. This is one thing I want you to note. Very important. Okay. Then in that case, the provision will be deductible. So two issues here. Number one, it must be a specific provision of a debt claim which the Commissioner General is satisfied as bad. And it must what? It must relate to prior basis periods or prior years. Then in that case, then it will be allowed as a deductible expense for the year under consideration. Number two, or B, in the case of a debt claim that constitutes the advance of a principal sum, the provision is deductible and the cost of the debt claim is reduced by an equal amount. So what they are saying is that the provision in the case of a debt claim, it should constitute the advance of what? Of a principal sum, not the interest, the principal sum. Okay, in that case, the provision is what? Deductible, and the cost of the debt claim will be reduced. In other words, you can charge that provision against the debtor figure, okay, to reduce the receivable. But please, the debt claim that constitutes the advance of what? A principal sum. Very important point. So when you're discussing provision for a debt claim, first of all, mention the fact that it should be a specific provision for that debt claim, which the Commissioner General must be satisfied as bad debt, but must relate to our previous basis periods. Number two, that debt claim must constitute an advance of what? A principal sum. Okay. Then in that case, the provision is what? Deductible, and the cost of the debt claim is also reduced by an equal amount. So it means that two things are going to be affected: your P&L, be your income statement, and then your financial statement of financial position. In other words, your debtors was reduced by that amount because this is a specific provision. And I want to say that if you get a question and it's a general provision, please don't worry yourself about it. General provision for bad debts or debt claims are not allowed for tax purposes. I repeat, the law is only giving room for what? When it comes to provision for debt claims, it's only giving room for what? To specific provision for debt claims that relates to what? Prior basis periods. Therefore, general provision for debt claims are not allowed for tax purposes. So the moment in the question you see a general provision for a debt claim, don't think twice. Disallow it if it has been allowed. If it has been allowed, you are going to add it back to determine the adjusted profit. Very, very important point. Where a person makes a provision and the person later reverses the provision, you see, you have made a provision and later you have reversed the provision. The law is saying that amount reversed, therefore, should be included in computing the income in the year of reversal. Okay, very, very important. Once you have what? Reversed the provision, then you have to return the thing back to income. Because when you provided specifically for it, you charge it as an expense in accounts, which was allowed. Having reversed the provision, what do? The amount reversed is therefore included in what? In computing the income for the year of reversal, the year that you did the reversal. Number two, the amount in respect of the provision reversed is included in computing the income. And for the one that the cost of the debt claim is what? Is therefore increased. So you therefore increase the cost of the debt claim because you have reversed the provision. Please note that at the advanced level, some of the questions are not computational. In fact, most of the questions are theoretical. I repeat, the advanced taxation, the emphasis is not too much on computation, but the emphasis is mostly on theoretical aspects of the law. So the treatment of issues, when we are learning them, take them seriously. And when you do that, then you are going to fly high. So what I'm saying is that when you are learning banking business, one of the key things you learn is keeping separate books of accounts and therefore determining separate chargeable incomes if a bank is engaged in activities other than the banking business. Number two, you must also learn how provision is made for debt claims. Know their treatment. Very important. That is what we are discussing now. And when we're able to learn this, that is all you need to know. So far as section 87 and 88 of the Income Tax Act is concerned. Then we are getting there. Okay, so that is that. That is that. That is fine. That is fine. That is fine. Now, section 23 does not apply to a debt claim to which subsection 1 applies. Okay, so banking business means that the banking business of a financial institution license. So like I'm saying, when you come to general provision for bad debts, it doesn't apply. It doesn't apply at all. It doesn't come in. It doesn't come in at all. Okay. Banking business means the banking business of what? A financial institution licensed under what? The Banking Act or the Non-Bank Financial Institution Act of 2008. So when we say project this particular topic as a banking business, we are referring to what? The banking business of a financial institution which is licensed under the Banking Act of 2004 at 673. Or so this can still stand for non-bank what? Financial institutions as well. So please don't go expecting only a bank, but it can also be what? The same principle applies to what? The non-bank financial institution. So that is where I took you through the practice notes, and I've done all that. And you see, so that brings us to the end of this particular lesson also. Like I told you, it's a very short lesson which can fetch you some nice marks for free. So just take it and you are there. Now there's this practice question from CIT, and I want students to again look at it and answer it and submit it for discussion. I'll mark it and then we are going to discuss as well. So CIT Advanced Taxation Practice, August 2016, question 5. You are a chartered tax practitioner in the employment of Hansen and Co., a firm of chartered tax practitioners. Your firm has accepted an invitation from a trade association whose members are made up of professionals within the financial sector of the Ghanaian economy to give a talk on taxation of financial institutions in Ghana, key issues at one of their seminars. The managing partner of your firm delegated you to honor the invitation on behalf of the firm. Required. Prepare the notes for your talk covering the tax aspects of banking and other business of a banking entity. Your notes should also focus on bad debts and provision for bad debts of a banking entity. And then bad debts what? Recovered. 12 marks. Which means you are going to get 4 marks for, in other words, 4 marks for each of the items that you are going to discuss in your talk. Okay. So the money partner has delegated you to go and honor the invitation and let your talk center on what? How, when it comes to tax rules regarding banking and other business activity of a bank, what is the rule? And when it comes to, now when you say bad debt, a bad debt is any debt claim for which you have taken all reasonable steps to pursue payment, for which you reasonably believe will not be satisfied. I repeat, bad debts. You know, we have bad debts and we have provision for bad debts. So in discussing this, when you are discussing the bad debt, here it means the debt has gone bad. The Commissioner General, it has fallen within the definition of bad debts in the Income Tax Act. Okay, and I'm saying that by the income tax definition, a bad debt is any debt claim for which you have taken reasonable steps to pursue payments, for which you reasonably believe will not be satisfied. Okay, and again, the bad debt must always relate to our prior years, prior business. It should not be for the year itself. It should rather be, it should have been included in the accessible income of previous years. Okay, maybe the bank gave advances. Maybe the year under consideration is 2019. Now, the bad debts that they are talking about here should relate to the years before 2019. Okay, and that one, the debt has gone bad. And you have written it of them in your books. Okay? In that case, the law says that you should allow it. Okay? Once the debt has gone bad, and it is genuine that this debt has gone bad, it's an allowable deduction. Then when you are discussing the provision for bad debts, talk about the specific provision and also talk about the general provision for the bad debts. Very important. Okay, so you will see that the B aspect of this question, you are talking about 3 things. You are talking about the bad debt itself, where the debt has in fact gone bad, and it should be debt claims that relates to prior years. And then when you are discussing the provision for bad debts, please talk about 2 types of provision. Talk about the specific provision, which is allowed once it relates to prior years, and talk about what? Talk about the general provision for bad debts, which is normally not allowed for tax purposes. Then the C part, what if the bad debt is recovered? We say yes, if the bad debt is recovered, in a year of recovery, it should be charged back to income. And what do? You also reinstate, okay, the debtor position of the person. I hope you'll be able to write something on these for further discussions. Thank you very much for this second lesson, and I hope you enjoyed it. Thank you. Thank you.